Welcome to The Explainer. I'm absolutely thrilled you're tuning in because today we're bridging the gap between two completely parallel universes. On one side, we have the world of accounting, and on the other, the world of tax. If you've ever looked at a company's financials and just scratched your head at the tax numbers, well, you're definitely not alone. Today, we're decoding IAS 12, income taxes, to make perfect sense of the whole shebang. So let's dive straight into this fundamental business paradox that trips up so many professionals. Imagine you're looking at a company's income statement. They're reporting a massive bottom line profit to their shareholders, right? But then when you check the actual cash paid out to the tax authorities, it's a completely different, often much smaller number. Why exactly does this happen? Why doesn't your tax bill almost ever align with your reported profit? To solve this mystery, our explainer today is going to follow a structured roadmap. We'll hit the profit versus tax problem, introducing temporary differences, deferred tax liabilities explained, deferred tax assets explained, measuring future tax impacts, and finally, why deferred taxes matter. Section 1. The profit versus tax problem. You really can't understand IAS 12 until you grasp this fundamental split in the financial universe. It's a clash of two rulebooks. On one hand, we've got accounting profit. This exists primarily for investors. It's built on accrual accounting, matching principles, and estimations of future economic reality. But then, on the other hand, we have taxable profit. This operates under a completely different set of rules dictated by the government, and tax authorities generally prefer hard facts and actual cash realization. Because these two systems have totally different goals, they calculate profit in completely different ways. Section 2. Introducing temporary differences. Now, let's look at the core mechanism connecting these two universes. The absolute crucial point here is understanding something called the tax base. Think of this as the taxman's version of your balance sheet. The tax base is simply the value the taxation authorities assign to your asset or liability, regardless of what your own accounting books say. For instance, if you have a loan receivable of 100 and repayment has literally no tax consequences, its tax base is exactly 100. But as you might guess, the taxman's valuation very often disagrees with yours. And when your accounting carrying amount and the tax base disagree, boom, you get a temporary difference. This is the exact problem IAS 12 is designed to fix. It's called temporary because eventually, over the entire life of the asset or liability, the total profit recognized is going to be the same in both universes. The difference is really just a matter of timing, when the tax is paid versus when the profit is actually reported. Section 3. Deferred tax liabilities explained. Okay, now that we know what a temporary difference is, let's check out the first flavor, taxable temporary differences. If your asset's carrying amount happens to exceed its tax base, you've got a taxable temporary difference. What does this actually mean in plain English? Well, it means you've claimed tax deductions early, or maybe recognized accounting income before it's been taxed. Ultimately, it creates a deferred tax liability, meaning you're going to owe the taxman more money down the road when you recover the value of that asset. You're effectively sitting on a future tax bill. Let's look at a classic real-world scenario, straight from the accounting standard. Imagine we have an asset, let's say a machine, that costs $150. In our accounting universe, it has a carrying amount of $100. But the tax authorities have allowed accelerated depreciation. They've already let us deduct $90 for tax purposes. Let's break that scenario down into a simple 4-step process to figure out exactly what we're going to owe when we recover this machine's value. Step 1, our accounting carrying amount is $100. Step 2, the tax base is only $60 because from the original cost of $150, we already deducted $90 for tax. Step 3, we subtract the tax base from the carrying amount, which gives us a taxable temporary difference of $40. And step 4, we just apply our corporate tax rate, which in this hypothetical is 25%. And the result of that quick calculation is a deferred tax liability of exactly 10. Because we got a nice tax break early on, we're going to have to pay an extra 10 in taxes later when we generate income from that machine. IAS 12 steps in and says we absolutely must record that liability today so investors aren't blindsided by that future cash outflow. Section 4. Defer tax assets explained. But what happens when the rules actually work in your favor? Sometimes you take an accounting expense today, but the taxman says, hold on a second, you can't deduct that until you actually pay cash later. This creates a deductible temporary difference, which gives rise to a deferred tax asset. It's essentially a future tax deduction just waiting to happen. From an accounting perspective, you've essentially prepaid your taxes. Let's look at another concrete example straight from the source. Imagine a company recognizes a liability of 100 for accrued product warranty costs. In our accounting universe, we recognize the expense the moment the product is sold, but the tax universe has a very strict rule. Warranty costs are not tax deductible until you actually hand over the cash to the unhappy customer. Because the tax base of the warranty liability is 0 right now, since the tax man doesn't recognize it yet, we have a temporary difference of 100. By applying our 25% tax rate to that 100 difference, it gives us a really nice deferred tax asset of 25. When we finally pay out those warranty claims in the future, we're going to get to reduce our tax bill by 25. However, IAS 12 has some pretty strict rules regarding these assets. You can't just throw tax assets onto your balance sheet blindly. You can only recognize a deferred tax asset if it's highly probable you'll actually have future taxable profits to offset against it. I mean, think about it. A tax deduction is completely worthless if your company is bleeding cash and owes no taxes anyway. You have to prove you'll make enough money to actually use the deduction, either through future operating profits or some clever tax planning opportunities. Section 5. Measuring future tax impacts. Let's dive into how we measure these impacts when things get a bit complicated. Because how you expect to recover an asset fundamentally changes the math. Imagine an asset was revalued, creating an 80-point temporary difference. If tax law dictates that recovering the cost through using the asset is taxed at 30%, but selling it outright is taxed at nil, well, you have to measure based on your expected actions. If you expect an immediate sale, 30 of old depreciation is clawed back at 30%, giving you a liability of 9. But the 50 of pure capital gain, that's completely untaxed. So out of an 80-point difference, the total liability is only 9. Oh, and here's a surprising quick fact about IAS 12 measurement. You are never allowed to discount deferred tax assets or liabilities to present value, literally no matter how far out into the future they occur. Section 6. Why deferred taxes matter. So why is all this effort actually worth it? The crucial takeaway here is that without deferred taxes, investors would be flying completely blind. They'd look at assets on a balance sheet and just assume their full value will turn into cash for the company. They wouldn't see the hidden tax landmines, the future cash outflows headed straight for the government. IAS 12 forces absolute transparency about the true future cash consequences of your current balance sheet. The standard demands that you account for the tax consequences of transactions and other events in the exact same way that you account for the transactions and other events themselves. This principle is just incredibly elegant in its simplicity. It means the tax effect perfectly mirrors the underlying business transaction. If a gain goes into your profit and loss, the related tax expense goes to profit and loss. If a revaluation gain goes directly to equity, the deferred tax liability goes straight to equity too. They are forever linked. So if your financial statements don't account for deferred taxes, are they really telling the whole truth about your future cash flows? I'll leave you to ponder that vital question, because understanding this parallel universe of tax accounting, those tricky temporary differences, those deferred assets and liabilities, is absolutely the only way to see a company's complete and honest financial reality. Thanks so much for joining me to demystify IAS 12. Keep digging into those numbers and always keep questioning what you see.